So for more on this data, we want to bring in our senior economics reporter, Steve Liesmen, also Betsey Stevenson, who is professor of public policy economics at the University of Michigan, and Joe LaVorgna, who is SMBC Nikko Securities America chief economist. Steve, we're going to go to you first for a little more context on those numbers that we're looking at. Up 0.3%, which is in line with expectations. But Rick pointed out some of these things that are very concerning.
Well, first of all, some things I think that might concern the Fed is that we're still not getting the sheltered disinflation we thought we might get. I think that's going to be a bit of talk about that today. 0.4 on the shelter after 0.3. I don't have the owner's equivalent rent right in front of me. That's another table I can call up in a little bit. But food at home is down. Talk about people are concerned. There's been some, I've noticed this, that in the circulars you get, there's a little more price competition, perhaps at the grocery store. That's up. Food at home, just 0.1% overall. Food, 0.2. And as Rick pointed out, gasoline flattering this index down 6% on the month, down 8.9% year over year. And then a big surprise here is an increase in used car prices, up 1.6. There was general belief this was going to fall. It did not fall. It was down 0.8 in the prior month. The reporting by Phil LeBeau had suggested it might fall because of his reporting from the auctions. Another interesting thing is we talked about all this holiday spending that's been out there. 2 points. One is that apparel is down 1.3%, but also real earnings, inflation-adjusted earnings, up 0.5% after being negative. So as you'll note, the CNBC NRF retail monitor noted a healthy gain in November, as did the Bank of America data you had on earlier this show. All of that powered by consumers, and consumers being helped by inflation rising less than in this past month. Their wages rose. Becky?
Okay, Steve, let's talk a little bit more about this with Joe LaVorgna. Joe, obviously, this has huge implications for what the Fed may be looking at. What would you take away from this?
Stephen made some very good points about what the Fed will look at. But, you know, the thing is, on the energy side, Becky, I think what's really important, energy now is down over 5% year on year. And as energy moderates, you're going to see all those secondary and tertiary effects, which bled into the rest of the CPI. Those will come out. Transportation, obviously, is a huge cost. And, of course, there's petroleum's in a lot of different products. So as energy moves lower, you are going to see your core rate drift down. And I think the trend is certainly lower. With housing, we're going to have a record amount of multifamily units built this year. And that really bodes well for much lower rental prices going forward. We are seeing the rental vacancy rate rise. These data will keep the Fed from being too dovish, but we're still on course for Fed easing, and we're still on course for much lower inflation.
Fed easing when?
I think next year, and I still would not rule out March. I know the market now is under 50-50 on a March cut. But if we get some weak data, we've got 3 employment reports between now and then, a March cut very much comes into focus. And that would actually be consistent with history when the Fed basically waits about 8 months from its last hike to its first ease.
Betsey, are you in line with that thinking? You think the Fed could cut as early as March?
Well, I think anything's possible, but that wouldn't be where I would put the balance of my probability. And that's not because I see anything bad in this report. I think inflation is moderating. I think that we're seeing what we want to see, but we know that getting all the way to the Fed's target is going, just to be a long process. And I think the way they succeed at that long process is they hold. I had wanted them to get to their high rate and hold for a long time. They've been doing that. And now I'm going to say on the other end, they're going to be real careful, and they should be really careful about when they actually start to cut, because what they don't want to do is cut and increase again. And we do still see some, it's not concerning trends. It's that we need to get inflation to their target. And so it's going to take some patience to get us all the way there.